Hey traders, welcome back to another lesson. This is lesson 7 in your introductory course. We're going to be continuing with technical analysis as this is part 2 of 2, and in this lesson we're going to be talking about popular price patterns and indicators. So let's get into it. So in the last lesson we spoke about trend and support and resistance. So now that we've grasped the concept of trend and support and resistance, let's combine them and see how they play out in technical patterns. So what are technical patterns? Well, these are distinctive formations created by price movements that involve trend and support and resistance. They offer clearly defined entry and exit or stop loss points. And as such, these are an important tool for traders to anticipate the future direction of a stock or even a market. So today, we'll be discussing the most important technical patterns. So one of the first patterns that comes to mind when it comes to technical patterns and the more important ones is the cup and handle pattern. What is that? A cup and handle pattern is a technical pattern where a technical area, the entry point, is tested over 3 times, and after the first test of that resistance point there is a big pullback. That forms the cup, and that's followed by another retest and then a smaller pullback, and that forms the handle. The trader is buying above the handle highs for entry and using the lows of the handle as the stop loss or the risk. Traders always prefer a trade that is showing a smaller handle. This will define the risk on the trade and consequently a higher risk reward potential. This pattern is normally valid on all time frames, intraday and daily charts. So looking at the chart on your right, you can see that a cup and handle pattern on the chart begins forming for Apple under that 156.50 resistance level. The level is first tested in February at 0.1, where you can see here, and then we have a pullback to the 144.50 level, and then the cup closes with a retest of that 156.50 level in March at 0.2. So you can see the cup highlighted by the green curve, that's the bottom of the cup, and then the retest right back to that resistance level at 0.2. And then, this is the important part, the handle is formed by a pullback to 147.60, and then it bounces back to the resistance level. Now to point 3. This is where we would get involved as traders. We would want to be buyers or going long following the break of that 156.50 level. So here we have point 3, and then we've now highlighted this entry point here. Our risk level was previously identified at 147.60 or just below. And as you can see, following that, Apple's price runs and breaks into an uptrend. We would then be taking profit along the way with reasonable risk to reward. So let's quickly recap the trade. The cup and handle pattern, its strength lies in the following. It encompasses the resistance level, you can see with the orange line, at the $156.50 level. The risk on the trade, which is formed by the handle and 9 points lower at that 147.60 level. And then it takes a substantial time to form, almost 1 month, making it easy to detect and trade for traders on multiple time frames. We'll speak more about the benefit of higher time frames later. So now we've come to the reverse cup and handle pattern. This is an example on a daily chart as well. And as the name suggests, it is the reverse of the cup and handle pattern that we just described. So a reverse cup and handle pattern on the daily chart begins forming for Tesla above that $269 support level. The level is first tested in September at 0.1 and is then followed by a move higher to the $314 level. You can see where the cup is formed. The cup closes back at the $269 level at 0.2. The handle is then formed by a $20 move higher, or a bounce from that support level to 289, following the reversal back to that 269. So Then the break under 269 at 0.3, Tesla trades lower by 50 plus points. So let's now look at the chart and go through the example quickly. First, we have that first test at 0.1, that rise and reversal, that forming the cup, then that bounce from support, and another reversal forming our handle and our risk level to 0.3, where we would want to be involved, and in this case we'd be getting short. So in the example, the reverse cup and handle, we'll be looking at going short at the break of 269 with a risk level or stop loss set at or just above the handle at 289, and taking profit into the flush lower with reasonable risk to reward. You hear me mentioning risk to reward. We'll talk about it more in the coming lessons, and you'll see how important it is, as it's such an important aspect of trading. Next, we have the bull flag and bear flag patterns. A bull or bear flag pattern is a continuation pattern. This allows traders to join an uptrend or downtrend by taking advantage of a halt in the trend and using a managed stop loss, the lows or the highs of the flag. The pattern can be traded by all traders on all time frames, intraday or daily. So let's talk about the bull flag with an example. Starting with the image on the left in the laptop, this depicts a bull flag. At points 1 to 2, we see the pole, which reflects a sharp move higher in price, and then price stabilizes between point 2 and 3 with a clear line of resistance and support. You can see resistance highlighted with the red line and support highlighted with the green line. This is our flag. Now at point 4, our anticipated entry point is where we want to get long in anticipation that the trend and the momentum will continue higher in our favor. Our stop loss will be at or just below the green line to the left of point 3. We call this a bull flag because it exhibits a bullish trend, meaning price is moving higher with momentum. It pauses, and then we anticipate that price will continue higher. And this means that bulls or buyers are in control of the trend, and that's where we want to be, on the right side of the trend. Remember, the trend is your friend. Conversely, if we think about a bear flag, this would be the opposite, with the trend or momentum to the downside, and we would be looking to get short to join the continuation of that momentum. So we would look for a pole showing a sharp fall in price, consolidation, or pause in trend, flag, and continuation. Let's now move on. So let's talk about the double top or the double bottom pattern. A double top or double bottom pattern is a technical pattern that occurs when price movement moves in a similar pattern to the letter W, which is a double bottom, or M, which is a double top. The double bottom suggests a reversal higher from the bottom in price, while a double top suggests a reversal lower from the top of the formation. The patterns can be traded on any time frame. The pattern must be very accurate when signaling highs or lows, so you want to be precise with these types of patterns. So in the chart above, we are viewing a double top on NVIDIA. The double top starts at point 1 and is confirmed at point 2. This suggests a trend reversal lower. Therefore, a technical trader using this pattern would enter the trade at as close as possible to the support level. A possible entry would be short at the break of 165.50 with your established risk level at or just above point 2, which is $192. To envision the double bottom, we can simply think of the reverse happening. If you flip this chart upside down, point 1 and 2 would be below, and our entry would be to go long. Now that we've covered the patterns, let's now talk about the advantages of trading technical patterns on longer or higher time frames. Trading technical patterns on a higher time frame has the following advantages. More traders are becoming aware of the pattern as time goes by, and therefore more traders will participate in the trade. Traders from different time disciplines entering the trade are welcomed. The long-term trader loves it when the short-term trader sells fast so they can buy cheaper, and short-term traders love it when the long-term trader's patience is in the trade, allowing them to sell at better prices. When a resistance level is tested 10 times versus being tested twice, it establishes it as being a valid resistance, and the same goes for support. So traders from all time frames will buy above the resistance level, and some will buy at the resistance level, allowing the price to move higher. Because again, multiple traders watching multiple time frames are getting involved in the trade. So in essence, trading on a higher time frame gives the pattern a bigger audience and stronger confirmation, and hence a higher probability of working in the trader's favor. So let's now talk about important indicators to traders. The first one we want to talk about is moving averages. These are probably the most used indicator in technical analysis. Traders and investors use moving averages, which can be applied to any time frame to better assess the trend on the instrument in question. Another way of analyzing moving averages is to figure out trends and support and resistance levels. While there are two dominant types of moving averages and various ways to analyze trends using MAs, the 200-day EMA or exponential moving average and the 50-day EMA are probably the most used in analyzing volatile daily charts. Two of the most popular signals used by traders are the 50 and 200 crosses. First, the golden cross, which is when the 50-day or shorter term time frame rises above the 200-day, signaling a shift to a more bullish tone in the market. And then you have the death cross, which is where the 50-day, the shorter term, falls below the 200-day, the longer term moving average, signaling a shift to a more bearish tone in the market. So let's now talk about volumes, another trading indicator. So trading volumes. Volumes are one of the most important indicators for traders and investors on any time frame. At its core, it often reflects the level of interest at each price area and can be used to communicate the pace at which participants are getting into or out of the market. Higher than average trading volumes may lead to aggressive price moves, lower or higher in the market, and even signal the start of a change in trend, a sign of traders rushing in to execute around a certain price area. While average trading volumes will most likely lead to a continuation or no change in trend, which is often gradual and orderly entry and exit of the market. Lower than average volume can lead to a pause in the trend or consolidation while participants figure out their next move. And lastly, trends can often continue without a major change in trading volume. A key point here to remember as well is a sharp move higher is not likely to happen without volume. Therefore, a way to spot false breakouts or breakdowns is when the breakout happens on average or lower than average volumes. So let's now continue to our final topic of this lesson, the VWAP, or the volume weighted average price. You'll hear this a lot in trading, and this is a technical analysis indicator used on intraday charts that resets at the start of every new trading session. It represents the average price a stock has traded at throughout the day, based on both volume and price. VWAP is calculated by totaling dollars traded for every transaction, or price multiplied by volume, and then dividing it by the total number of shares traded. VWAP is primarily used by short-term traders and is a trading benchmark that provides traders with pricing insight into both the trend and value of a security. Institutional buyers, including mutual funds, use VWAP to help move into or out of stocks with as small of a market impact as possible. Therefore, when they can, institutions will try to buy below the VWAP or sell above it. And that's all for this lesson, traders. Thanks for tuning in. See you at the next lesson. Take care and bye for now.